Hello and welcome. Thanks for joining us today. I'm excited to be here with you to discuss the FASB accounting standards update related to crypto assets that was issued late last December. Before we begin, I want to say that I think this webinar comes at a great time just to continue the momentum of some of the digital asset conference circuits. Swell, hopefully next week, currently permissionless out in Salt Lake, mainnet last week, but specifically for this audience, there was the Crypto Finance Forum that was held in New York City last week. Some amazing content, great speakers at that event with FASB themselves making an appearance. And the supervising project manager for this exact update was there engaging in some great discussions on this exact update. There was also a newly released documentary last night on Bitcoin. So the digital assets are seemingly popping up all over the place and integrating themselves everywhere we look. But to kind of start us off, my name is Graham Mikic, and I'm a CPA based in New York City that leads our firm's digital asset practice on the advisory side, which basically engulfs a variety of different engagements related to the industry and their intersection with corporate accounting and tax compliance. My team helps various client profiles, miners, Web3 developers, with a variety of just tactical and technical challenges that they face, but ultimately we serve in the capacity and needs of an entire accounting and finance department. Now, a bit about myself. I got into digital assets where I co-founded a proof of coverage mining startup as CFO prior to COVID, and experienced firsthand the ambiguity and difficulty doing the fundamental accounting tasks such as rev rec or how to report these items on the balance sheet. But ever since then, I've been really passionate personally and professionally about the industry, and really enjoy working with our clients on their challenges. So with me today is one of my colleagues on that team, Jed Lee. And Jed, I'll let you introduce yourself.
Hi, everyone. My name is Jed Lee. I'm a senior at Cherry Beckert, senior in accounting advisory practice. I'm happy to be here. I'll probably touch more on technical accounting side and the standard update overall, but I think this is a very exciting and interesting topic to discuss with you guys. So happy to be here.
Thanks, Jed. So here's where we land in terms of the content of what we're going to discuss here today. But it's all around this important development in accounting and the financial world that impacts how we're going to report these type of assets, and then similarly disclose those related activity. Now, again, I don't want to undermine the importance, because this is, I think, a big milestone in the industry's been asking for since we were told to apply that impairment, ASU 350/30 guidance. But as the industry continues to evolve, so must these regulatory frameworks. The emergence of these assets has brought just a clear need for consistency, and that's where this ASU 2023-08 comes into play. So today's presentation will cover these following key areas. We're going to begin with an overview, explain what the standard entails, why it was introduced, go through the evaluation scope, measurement, again, presentation, and these required disclosures. We'll also try to provide some guidance on how to implement these new requirements, try to give you some practical steps and what we're kind of seeing as leading industry practices. We'll also want to discuss the potential impact of these new standards on the financial statements, which again, hopefully will help you understand what challenges and changes to expect and how to prepare for them. Now, to bring these concepts to life, we're going to attempt to go through a mock portfolio of digital assets and hypothetically determine this application based on the scope criteria. We'll also look at the disclosures that some of the public filers have already adopted, and some of the terminology lexicon that they've included in their statements. And finally, we'll wrap with some of our own experiences and with some of our case studies that we've seen thus far, and then hopefully have some time to help answer any of your specific technical questions to conclude. But again, today, the goal of the session is really to equip you with the knowledge, the tools you'll need to effectively implement this standard within your organization. By the end of the presentation, hopefully you'll have a clear understanding of what this new standard entails and be ready to apply them in practice. But before we begin with some of the technicalities, I wanted to set the context for the conversation by reviewing the current state of the industry. And in terms of market dynamics and some of the influences, still very dynamic. This continues to evolve. We're adapting in response to economical changes, regulatory developments, and innovations across the industry. But in terms of where this all started, we can always start with Bitcoin. It's the market leader. It's the OG. It's seen a remarkable recovery since this time last year, basically doubling. I know it was around 30, and this morning it was hovering around 61, 62,000. But we're seeing this surge of institutional adoption. Large corporations are recognizing Bitcoin as a serious asset class. So think, Semler Scientific and some of these maybe non-native crypto companies starting to put digital assets on their balance sheet. But amid this backdrop, too, we have to remind ourselves that the world's also facing a lot of economic uncertainty. There's a US election in less than a month, inflation, interest rates, foreign conflicts, again, have led some investors at least to seek alternative stores of value to some of these traditional safe havens. Down now to kind of the trading volumes, we saw the introduction of these ETFs in the beginning of the year, which is groundbreaking. There's talks and murmurs of potentially more being potentially approved. Looking at trading volumes, these centralized exchanges have witnessed a huge resurgence and made a comeback. This year, the first quarter, the top 10 exchanges recorded over 4.2 trillion in trading volume. So that's almost over a 95% increase from the previous quarter. And then as of October, today, the top centralized exchanges continue to improve and show robust trading volumes. Obviously, Binance is going to be the dominant player with over 12 billion in daily volume, but Uniswap and some of these other DEXs are also growing. Justin from Uniswap was again at this forum, and spoke a lot about how their V2s and V3s are still maintaining their prominence and generating almost $120 million in daily trading volume on ETH. Going to the redheaded stepchild, kind of the NFT market, which historically faced a downturn, is now rebounding. Some of this activity is driven by new collections, games, and really the rise of ordinals, which are these NFTs inscribed on actual sats. But all of this really does lead us to the regulatory front. You see the headlines: SEC, Ripple, Coinbase. I for one am very glad that we have some of these large institutions being able to spar with the SEC and having these discussions, because that's how we're going to set precedent, educate, normalize this industry for, again, further maturity. But basically, to sum it up, this industry is vibrant. It continues to evolve. 2024 has been a very dynamic and transformative year. Despite facing these challenges, the industry and the sector continues to grow with, again, increased interest, resiliency, and I'm excited to see what the future holds in this market. But for today's discussion, it comes back and circles back to accounting guidance, right? So to now dive kind of more headfirst into unpacking this update, I'm going to pass it over to Jed to start diving into the details. Jed?
Sounds good. Before we get going, Maddie, I see your hands up. Okay. So is there something that you wanted to discuss, Maddie, before we move on?
I think she's her PC is rebooting, so all good. You're welcome to go ahead, Jed.
Okay, awesome. Yeah, so I'm going to spend about 15 minutes to quickly go over the new standard update. We're going to look at the scope and the disclosure requirements and whatnot. But before we get into the nitty-gritty of it, I kind of want to give you a quick overview of what this new standard update is all about. So It was issued last year, so December 13, 2023. And now essentially for any digital assets that are in scope for or subject to the standard update will be subsequently measured at fair value. Previously, it was not measured at fair value. And the standard update also provides some additional disclosure requirements that are beneficial for the readers of the financial statements. And these requirements or the standard update will be effective beginning after December 15th of this year. So if you look at, there is about 50-page long basis of conclusion from, FASB that came with ASU 2023-08, and they kind of describe the reasons for this issuance. The first and the foremost reason that they addressed was the decision useful information for investors. And they kind of heard from investors and the readers, as well as the practitioners that there may be a little bit of too high of a cost and complexity in the current accounting model over cryptocurrency. So that was kind of the second reason that they decided to issue this update. Third piece goes back to the first point. So the costless impairment model are not really accurately valuing the crypto assets that are subject to this standard update. So again, going back to the first point, decision useful information for investors. And then the last reason is that investors kind of requested more disclosure around crypto assets. So that's kind of the quick overview of this new standard update. And before we dive into it further, I kind of want to show you where we were at in the past before the standard update. So the ASC 35030 is the intangible asset accounting standard code. And under crypto assets are used to be under all intangible assets standard code. So they were measured at cost initially, and then they were tested for impairment for each reporting period, and there was no reverse. So if impaired crypto assets had a higher fair value than the carrying value, then the companies were not able to mark it up to the fair value in the past. And obviously, they are intangible assets because their useful life is kind of indefinite, so there's no amortization around it. Third point we already discussed, and then the last point here, any crypto assets that are not subject to this new standard will continue to be subject to this 35030, so the general intangible asset standard. So with that, here is a quick comparison between where we were at and where we are headed to. So 35030 versus 35060. The measurement difference is cost less impairment versus fair value at the end of each reporting period. Impairment, it's remeasured, just like I just mentioned, as opposed to under the new standard, the fair value will be captured. Reversals are not allowed under the conventional accounting standard, as opposed to the new accounting standard. All crypto assets will be measured at fair value as long as they are subject to the scope. And then under the previous guidance, previous code, the limited disclosure requirements were available, as opposed to now there are more enhanced disclosure over the crypto assets. With that, I think we have the first polling question here. What is the main digital asset in your portfolio? So I mentioned a lot about scoping, if the crypto asset is subject to this new standard or not. And that is kind of the most interesting piece for companies to look at, is whether our or my crypto assets are subject to this new crypto asset accounting updates. And there are about 6 criteria that FASB really listed out. And the first piece is the definition. So crypto assets should meet the definition of intangible assets as defined by US GAAP. So kind of easy one, right? So intangible assets are non-physical assets with some monetary value, and crypto assets exist digitally, but it also provides an economic benefit to a company or holder. So it meets the intangible assets. Second piece is more nuanced overall. It reads, it does not provide the asset holder with enforceable rights to or claims on underlying goods, services, or other assets. Crypto assets necessarily do not grant the holder any rights to physical assets or services. But if your crypto assets are wrapped coins or stable coins, they are somehow pegged to some other assets. So that may create the enforceable rights. So they may not fall under the criteria that FASB listed out here. And we're going to look at the example a little bit more specifically later in this presentation. The third and fourth piece is really all about cryptography. So third piece here, the crypto assets are created or reside on a distributed ledger based on blockchain or similar technology. The basis of conclusion 19 from the standard update talks about why this criteria was necessary. This criteria was necessary because without this, some other intangible assets could have been a crypto asset, such as contracts with customers, guarantees, and insurance contracts. So these two pieces are kind of making sure, or gatekeeping, that the intangible assets are based on cryptography and technology, blockchain technology. The fifth piece here, I think FASB is trying to draw a line pretty clear that these crypto assets must be fungible to be subject to the fair value measurement. So we have a crypto asset we call digital asset, NFT, and non-fungible tokens. They're kind of automatically not subject to this scope, so they'll continue to be treated as an intangible asset as opposed to crypto asset. So kind of an interesting but also important criteria to point out or highlight. And number six here, crypto assets are not created or issued by the reporting entity or its related parties. But this piece doesn't equate or mean that miners or Bitcoin miners or crypto asset miners, they're not subject to this particular criteria. So meaning that receiving crypto assets from mining or validation is not considered creation or issuance. So if you received crypto assets as a result of mining activities or similar activities, they are still subject to this new standard update. So I think that's kind of a good news
just chiming in on this one too, because we did have this conversation with FASB last week. And I mean, the reason why this criteria exists is kind of self-evident. You don't want issues of their own token just having the ability to value and write up because they have control over again the entire storage of it. So big topic of what this applies to, but it does boil down to these bulleted points, your starting point in terms of criteria. But sorry to jump in on that one, Jed.
No, you're good. Yeah, thanks for sharing that additional piece of information. All right, so now we're going to jump into initial and subsequent measurement very briefly, and then move on to the disclosure piece. In terms of the initial measurement, the standard update doesn't necessarily address it. And I think that's a wise move because there are a lot of complexities around initial measurements. So really, I think the point that the standard update is trying to make is consistent practice over how you initially measure your crypto assets that are subject to the new standard. Purchases, typically if you purchase a crypto asset that are subject to this, you will be able to measure it at fair value, and it has to be remeasured in the subsequent period. And the third piece, if you receive crypto assets, by exchanging or providing goods or services, they should be measured at fair value at the contract inception date. And the price difference between the inception date and the date that you receive the crypto assets will be captured at the subsequent measurement period. So that's kind of a super quick summary here. Subsequent measurements, fair value of the crypto assets have to be remeasured at the end of each reporting period, and gains or losses has to be captured in a different line item from income statement. Let's dive more or deeper into the disclosure. There are lengthy documents about what they're requiring, but we try to condense it into 8 particular points. So the first five here says present companies are required to present crypto assets on a separate balance sheet line. And then any gains or losses from crypto asset activities, fair value remeasurements should be presented separately in the income statement. And if you are a company that receives crypto assets in the means of payment and you nearly immediately convert the crypto asset into cash, which means as soon as you receive the crypto assets and you convert it or sell it in the next hours to 2 or 3 days, then you can treat it as a cash instead of a digital asset or crypto asset. And you have to disclose some material crypto asset holdings, their name, cost basis, fair value, and the number of units held, and then overall cost basis method that you're using in your notes disclosure. And then 3 additional here, you have to provide activities of the year or of the reporting period, including additions, dispositions, gains, and losses in a separate note. And then the description of the activities as well. Was it a purchase? Was it received from customers? Was it from mining activities? And then the last piece here is how long, the nature and how long you have to hold this asset. If you have to, there are some certain sales restrictions. So I think this is kind of a very unique situation that you would have to provide a disclosure over, but it is a required disclosure if you do have these conditions, sales restrictions.
And Jed, jumping in again, just because again, this is a requirement, but if you kind of start going through the 50-page document, it's still very left up to a subject of interpretation, right?
Yep.
What is important? What is top assets related to your organization, right? Does it mean top 5, top 10? Is it a percentage? Again, very, very subjective up to interpretation, but our suggestion and recommendation would be to start engaging, your accounting stakeholders, your auditors, have these conversations. What does it look like so you can get ahead of things? But again, another hot topic of conversation with FASB themselves last week.
Great, thanks. With that, we can move on to the second polling question, and then I'll give the baton back to you, Graham.
Thanks, Jed. And I will say, as we kind of have this up, that this was a welcomed update in terms of the specifics. Obviously, there was some intentional scope omissions. We did touch on issuers, wrap coins, and there is a method to the madness in terms of FASB's rationalization. But I will say, in order to kind of continue to see these updates and to get on the FASB's agenda, they directly told us, hey, we want feedback from the industry. We want to hear what you guys want to see on our calendar for discussion. So please, 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 if there is any topic conversation, directly reach out to FASB or work with some of your, groups. I know here in New York, the New York State Society of CPAs has a digital asset subgroup that we can, start filtering and funneling some communications up to the ears and powers that be. But again, this is very much still a moving target. I expect to see a lot more clarifications coming from FASB on this topic, and here's just a small first domino to fall. But I guess with that, we can continue to move on. Let me see if I have control and push this. Oh, sorry, we didn't see the polling questions. Wow, all right. About almost over half have a non-existent for people responsible for this. So always good to know where you're kind of starting from, which basically dovetails into kind of the I guess silver lining of this next topic of preparing and making the actual transition, right? So here's where we land in terms of the high level framework, right? It all boils down into these few main points. But the first tenet is around, like I said, gain an understanding of where you came from. you want to make sure that you know exactly what tokens are in your company wallets. And since each have to be evaluated individually against this new scope criteria that Jed just ran through, it's going to have a couple landing spots in terms of in scope and out of scope. Hearing myself say that, you actually should really make sure you define the wallets and the custodial responsibilities assigned to your company. So again, you don't want to be mixing or commingling, maybe co-founder or personal wallets with corporate wallets, and keeping that iron curtain in place is really important. The next idea, though, in the middle is about gaining an understanding of how you're going to handle this during, and then basically listening to the disclosure requirements after the transition, right? Start planning who's going to be responsible, what systems you're going to need to either adopt or be reconfigured. What's the process? Where's it going to live? And do we have the required data to report on this continuously? Because once you're out and it's on, you have to continue that momentum and report at every period end. So I'd get a project list going of all these potential improvements, upgrades, roadmap them. Can your current sophistication and infrastructure support these new requirements? How much of manually is it? Can we automate some of this? How should we price and value these assets, right? But then from that plan and trying to map out some of these foreseeable challenges, try to start creating solutions to remedy those. Engage with your subledger vendor, pick a subledger if you don't have one, train your team on the new process. Essentially, again, do as much prep work as you can before you making it. And again, I think this just kind of echoes the proverb, measure twice, cut once. Because just because you can have the ability to report a fair value from a regulatory guidance, can you from an operational side? Like, meaning, do you have the abilities, data, tools, sophistication to manage and report against these new GAAP guidelines? Because, like, as you just heard from Jed, it really isn't any new concept. Intangibles has a framework. If it's not intangibles, it could be 820. If it's not 820, 815. The ASCs and FASB have landing spots and mechanisms for all this. It's just really, in my opinion, an increase in the required disclosures, and again, a token by token analysis to see which is in and out of the scoping criteria. And then let me just move to the next slide. So yeah, the first step, like I said, is planning. We all know the effective date, but that's for fiscal years beginning after 12/15. So if you're like most companies on a calendar year, your fiscal year begins January. So effective transition deadline is basically next year, end of next year. Like Jed said, FASB says you don't have to wait. You can early adopt as long as the statements haven't been issued yet. But again, considering we're in October, if you haven't adopted already, you're going to do next year because that's the deadline. But the theme here, again, is to plan, prepare extensively, try to understand all perceived impacts. I think the elephant in the room, or what I'm alluding to, is the MicroStrategy situation where they haven't adopted yet because of some of the real tax implications, but rare outlier situation. I don't think anyone on this webinar owns over 250,000 Bitcoin like they do, or have the magnitude or scale of that issue. But I think it highlights at least some of the unforeseen challenges that come along with transition. A paper gain in terms of unrealized amounts does trigger an actual tax implication. But also might be smart to engage your auditor, try to align on their needs, create the required documentation and support that they're going to need from you to kind of do their test work and make sure that their audit goes smoothly supporting this transition. All right, so we've planned. Now, what's the first real application? Is apply the scope criteria to the holdings. Again, I'll highlight and reiterate, it's on a token by token basis to understand which assets qualify. So again, later we'll review and walk through that hypothetical on how to do that. But essentially, you need to review every type of token to see if it qualifies against those 6 points that Jed explains. They're intangible, fungible, don't have any rights to underlyings. But again, I think I said it before, at the end of the day, it can be somewhat of a subjective analysis based off of a legal assessment and the actual enforceability in terms of the T's and C's of each token of what you're holding. Read the white papers, understand the fine print, what actually has been assigned, what rights have been in kind of purchased for these holders, and be sure to engage and collaborate with the respective legal departments to review these contracts to make those determinations. But if they do meet the criteria, then they can be moved into the in-scope bucket and then be applied the fair value adjustment process at the end of each evaluation period. Otherwise, they're going to be remaining in that legacy model and still be evaluated for impairment only. You also should review your sources of where these transactions are coming from, as well as the types. For instance, there is some implications if you're doing any intermediate or advanced level of accounting with crypto assets, for instance, hedge accounting. So before adopting, this was kind of a workaround. If you were using a crypto asset as a hedge, they could be and were allowed to be remeasured at fair value already. However, if you do adopt, that would disqualify and basically not allow that crypto asset to be eligible and designated at a hedge item under 815. So again, there are mechanisms, there are models, but there's a bunch of considerations that you want to think through if you have any sophistication or advanced accounting treatments or situations. But once you understand which assets will be applied this new treatment criteria to, the next item relates to pricing and using a consistent principal market for determining the value. Hopefully, you've through that planning process, you've already performed your principal market analysis and have that conclusion based off of your specific volume, liquidity and reliability of the data. So once you have that piece, it really just becomes a valuation is quantity times price. So again, nothing overly complicated or new in that sense. Continuing on, the next application in terms of this planning and transition title is understanding the systems, processes, teams, the 3 legs of the proverbial stool. Technology is your best friend here, since I don't think anyone wants to do this stuff manually, especially during an audit. But it's vital that your subledger is capable of handling the complexities of these transactions, the volume of these transactions, and should have the availability or to automate at least certain processes. I know some ledgers, it's a one push of a button that as of a timestamp you'll get everything written up or down based off of that fair value. It's pretty seamless, and they've been able to kind of integrate it into the month end. The expected process is also really important to formalize. Codify these new policies, set expectations, begin providing your team training guidance, how to incorporate this new treatment and again, associated reporting processes, which brings me to that the personnel side of things, the delivery model, the team. The success of this transition and ongoing process to fair value accounting really does hinge on the expertise and readiness of the folks that are doing and executing the job. I think it's imperative to spend a lot of time training, help the team understand, see the bigger picture, what the new process, what the ongoing expectation is going to be for that's impacting their job, right? But ultimately, in this adoption and the effective transition is where the rubber meets the road. Once you've scoped your portfolio, understand what's in scope, have done the actual calculation of fair value less cost basis times quantity, that should give you a dollar amount that you adjust through retained earnings or your deficit if you're running a cumulative deficit. As again, this cumulative effect of adoption, they say the cumulative effect of adoption ASU 2023-08. Pretty branded, straightforward. So readers of the financial statements are going to be looking for that if you've made that transition. Um, quick comment too on some of the intermediate treatments, because previously entities were able to use or have been required to use mark-to-market accounting for tax purposes. So if you've been doing that, you may have a deferred tax impact that I think would get eliminated under adoption. So just carefully consider and analyze what your accounting methods for tax treatment, just to ensure that this adoption, everything's appropriately considered and reflected appropriately and accurately in your financial statements. All right, so what does this ongoing process look like? Really, it should be witnessed through the lens of your subledger, since again, the actual calculation can get hairy depending on when you're evaluating this in terms of period end. What is that evaluation period activity look like? If you're acquiring and off ramping digital assets, how are you tracking those cost bases for when you get to the end of your period that you have to write up or down to fair value? You still have to keep the same inventory methodology alive, such as FIFO, average cost, whatever you've been doing, because again, you don't necessarily want to change the basis of your methodology or accounting treatment. That might cause some red flags. But now that you're moving and having a lot more write-ups or downs, the tracking can really snowball if you're doing any of this manually or have any type of significant volume. Another just quick plug to Uniswap, they have 1 million line items pretty much on a daily basis, so heavily rely on their technology solutions. But like I said, throughout, a lot of this is subject to interpretation. You do have some availability in the frequency of your evaluations. Guidance doesn't say it has to be on X date. It just says reporting period. It doesn't really define further. So I have certain clients that automate and adjust on a daily basis, where others do on a month-end close. But either way, once you have the calculation, you make sure you basically run down all the entries and to the GL to see how it affects the financial statements and confirm the accuracy. But be sure to save off and keep a real inventory of any granular report, supporting information, lot information, cost basis tracking, related to these adjustment entries. But again, some of these subledgers do a great job at this, which is again ideal for when you're going through an audit. The other side of fair value change is the reporting compliance, the footnotes, disclosures. Now these are required and need to be maintained and reported consistently. So organizations should still try to include as much relevant information as possible. But like I said, it's still subjective. Make sure you're collaborating with your stakeholders, auditors, to align what's the best solution for your organization, right? But in essence, that's some of the technical details, the practical applications of this update. We wanted to share with you, and kind of think this brings us to our third polling question. So how comfortable, hearing what you've heard from Jed and myself, are you with this process of adopting and maintaining this new fair value guidance on your crypto assets? Well, as those are kind of populating, and with our understanding of the background of the update, the technical details, the plan, let's review how to put this into a kind of a practical application. I'm going to repeat, this is hypothetical. These results are going to be unique to this mock portfolio. Don't interpret this as actual guidance for your situation, as close or familiar to this as it may look to the real world. But after taking a look, we see some of these hypothetical layer ones, such as BTC and ETH. But I also see a wrap token, potentially a stable coin, and then at least for the Union Sushi Swap tokens, look like LP tokens, which are liquidity provider tokens. So this is kind of a great full gamut. And oh yeah, and then everyone's favorite, a potential NFT at the bottom. But this is not atypical of what a portfolio could look like depending on what you're involved with. But first thing, like we kind of said, is you need to start identifying what do these tokens represent based off of their disclosures, their terms, all of the terms and conditions that you read and understood thoroughly before purchasing these assets. But once we understand what our token holders' rights are, we're going to walk through the 6 scoping criteria to test if they apply. And I think with that, I'm going to maybe pass it back to Jed to kind of walk through that determination.
Great. Yeah. Just like Graham said, this is kind of a mock portfolio, and this is kind of our interpretation of how we would personally, as a firm, report it or classify it according to the new accounting standard update scope. So if you go back to the previous slide, we have about 9 different tokens. And we are going to bucket these 9 different tokens into 4 types of crypto assets. The first is in-scope assets, and from now on, I'm going to call the in-scope assets as crypto assets. The second bucket is not NFTs, so non-fungible tokens. And then the third is REPT or liquidity pool tokens. And then the last is stable tokens. When you determine which crypto assets falls under what bucket, I think the most important question that you want to ask is, what is the characteristics of this crypto asset that I'm holding? And then the second question is, what contractual rights does this crypto asset or token have? So starting with NFT, obviously they are not fungible. So that's why they're called NFTs. And just like the scoping criteria number 5, crypto assets must be fungible to be remeasured at fair value. So that basically means that NFTs will have to be continuously subject to the previous guidance or the intangible asset guidance 350/30. Moving fast forward to REPT or LP tokens, they're basically REPT tokens that are pegged to a different kind of tokens. For example, if I have Bitcoin and I want to trade in the Ethereum platform, I would rep my Bitcoin to be traded in the Ethereum market. So that means it gives me a legal right to some degree to a different asset, right? So there is an enforceable right for me to acquire an asset, which is, like in this case, Ethereum coin. So that may mean that REPT tokens or LP tokens may not be subject to this new fair value measurement scoping criteria. And similarly to REPT tokens, stable coins are somewhat different since they are pegged to fiat currency. So USD or Tether, for example, is pegged to 1-to-1 US dollar. So they're more seen as a financial asset than an intangible asset. So if we go ahead and bucket this mock portfolio, here are how we would personally determine whether it's in scope or not. So the green highlighted here are in scope. So Bitcoin, Ethereum, and AVAX, MOG, they are subject to the new fair value measurement. And then the orange highlighted are still subject to the intangible asset criteria. And then the Moonbird number 38 is a non-fungible token. And the next step, TBD, that basically means that you have to determine what to do about the fair value measure. I'm sorry, the cost less impairment measurement and one that's just similar to the 350/30 tokens. And USDT, as I briefly mentioned, are more of a fiat currency pegged. So it's a financial asset more so than current or crypto asset. With that, there are a few publicly traded companies that have gone through the transition. Graham, is there anything that you want to highlight out of this? Otherwise,
sorry, this is just where we're seeing this exercise really being applied.
Yeah.
There's your top filers, but the elephant in the room with the MicroStrategy situation. But again, no one else is going to have $3.1 billion of impact or retained earnings.
Great. Okay. So in this presentation, we're going to look at 2 companies. So the Marathon and the Block. We're going to look at the balance sheet, income statement, statement of cash flows and footnote disclosures. Since we're under kind of time crunch, we're going to go through really quick. The first piece here is the balance sheet side. So Marathon has decided to disclose their crypto assets separately from the other assets. They decided to do so because about 60% of their total, our current asset, is made of digital assets, right? So they decided to do so. As opposed to Block, they just bucketed it under non-current assets. Why? Because it's about 2%, slightly over 2% of their total asset is made of some different kinds of other assets that includes crypto assets. So crypto assets must be presented or shall be presented separately from other intangible assets. Moving on. So this is Block still, and this is a note disclosure 13, which is where they separately presented through the note disclosure, not directly from the balance sheet. So their other non-current assets are made of investment in equity securities, Bitcoin, and then restricted cash and other. The second and third disclosure examples that we're going to look at are this here. Instead of reading it through, I'm just going to take you to the example directly. So the first piece here from Marathon, they kind of carved out and gave a whole detailed disclosure over digital assets, explaining what kind of cost basis methods they decided to go with. So the first beginning period, January 1st, 23, they used FIFO, and then starting March 31, they switched it over to LIFO. I think that to me means they're trying to smooth out a little bit of a real or unrealized gain or loss situation here. So when we take that piece to P&L, this is how it's shown on their income statement. So gains or losses on digital assets, and then gains or losses on digital assets held within investment fund. I decided to show this separately to make sure that digital assets held within investment funds, I think, is more of a financial asset. It's an investment asset, as opposed to gains on digital assets or really intangible asset recognition there. Moving to the Block example, they're giving you the similar description. So FIFO method is what they're using for their cost basis. And they are presenting the remeasurement gain on a disclosure, notes disclosure instead of income statement, I think. Yeah. And here, from a statement of cash flow side perspective, it's gain or losses on intangible assets are not necessarily operating activities, right? So they have to be reversed out on the operating side, but then they are fully recognized on the investment side. So both Marathon and Block here are reversing out the remeasurement gain or losses, and then fully booking it under investment activities cash flow side here. So here are the examples. And this is Block's example: purchase of Bitcoin investments, proceeds. All right, and then, sorry, yeah.
No, sorry, I not to jump in, but I would also suggest taking a peek at MicroStrategy's docs, because they've been pretty innovative trying to provide as much information, and even their CFO was speaking to their strategy as Bitcoin as a treasury asset, and they've even developed new KPIs in terms of yield to investors that, again, I thought was very interesting in terms of how they're communicating not only their strategy, what they have going on under the hood, but how it's impacting their investors on a very specific level.
Great. So to continue on, so this is how Marathon decided to disclose on their equity phase statements, the cumulative adjustment that Graham mentioned in the transition period slides. This is how they decided to disclose on the Marathon side. And then moving on, this is how Block decided to do. A lot of similarities here. I'm just saying cumulative adjustment due to adoption of 2308. And then kind of an additional disclosure here in their notes disclosure. All right, and then the last piece that we're going to look at are the activities and reconciliations and a highlight of what kind of activities that you perform to gain the Bitcoins. So here, Marathon only has Bitcoin as their crypto assets, and their cost basis, quantity, and fair values are disclosed as such. And the second box here kind of shows you the activity. So addition of digital assets, disposition, realized and unrealized gains or losses reconciled in this table. Similar thing is done by Block, their financial statements underneath their Bitcoin or digital assets notes disclosure. So a lot of really good examples that you can, learn from these two companies. We don't mean to advertise these companies or support these companies by any means. We thought that it's a good educational material to kind of look at it together. And with that, I think we can move on to the last polling question. Are you interested in speaking with someone from Cherry Bekaert about accounting for cryptocurrency?
That's the softball. All right. Well, while we're answering that, and again, I just want to leave some time for Q&A. But we just wanted to share some case studies that speak to the fact that this is a very much developing industry with new opportunities, new flavors, new business models, environments every single day. And really, I love this subheader, this tagline about digital asset. The adoption implementation, because it's pretty frank, right? Not every organization will face the same set of challenges, based on a variety of factors, and just for instance, like I have, miners that need a lot of foundational, accounting infrastructure, the blocking and tackling. Some of our clients are public or OTC filers, and we need to, provide those respective Ks and Qs. But we're really just trying to treat this as and apply legacy or traditional accounting needs and tools and sophistications to this model. Obviously, the maturity is brand new. We're still very beginnings of establishing the foundations of this really disruptive and peanut butter type industry, just being spread across and touching pretty much all aspects and facets of our economy. But along with just the CFO's compliance side of things, we also lean heavily into tax compliance, forensic cleanups, whatever skeletons in the closet you think you have. We've partnered with great node operators and vendors that can pull all our transactional data, wrap our hands around it, and start to analyze it. So I'll conclude with kind of just repeating that subledger and say that digital asset adoption implementation takes a variety of different models, and respecting accounting needs to support each one. So as we move towards Q&A, I think it's really essential for all stakeholders, investors, everyone on this call, to stay informed, be engaged with the community, be privy to these developments, because the future of this industry, I believe, holds immense amount of promise. And I do want to thank everyone for the attention on the subject. And I guess with that, we'll turn it over to Q&A. And all right, so we have a lot of questions about just the content and the slides. All of this information is going to be sent out within a couple of days to the email that you folks use to register. But but specifically, what are the tax implications for MicroStrategies for adopting if taxes are still only based on realized gains? Great question. Basically, it comes from this CAMT trigger, where if they had retained earnings or excess earnings over the past 3 years over a certain threshold, that would trigger a certain corporate minimum tax. So again, just paper gains affecting retained earnings and bottom line is impacting real tax implications and actual outflows of cash. What about stablecoins, wrap tokens, issuers? I think we kind of hit on some of those. Stablecoins is kind of a loaded statement. Not all stablecoins are treated equally. Please read, what enforceable rights and claims to potentially other assets. If they don't meet the scope criteria, they could be classified as financial statements or financial instruments. Wrap tokens, I think we touched on it, but that was intentionally omitted from the scope. FASB, again, there is a method to the madness, as well as why I think it's the last scope criteria, number 6, applies to issuers. You can't be writing up and having control over assets that you directly can manipulate. How, during these fair value assessments, what's the best practice for determining principal market for a crypto asset? That's a great question, because I do think there's some confusion. Hey, I'm using a price aggregator and picks the best of every pricing source out there. All right. Well, that's not GAAP, right? The guidance specifically says you need to do a principal market analysis. I think the underlying concern, and I have talked to auditors, is how can you be sure that you're not cherry picking the best market value at a certain date? So just underpin all your processes with an air of standardization consistency. If you can say right, wrong, and different of how the market's reacting, this is our inventory methodology, this is our costing mechanism, this is our price at this specific time. Standardize, formalize, codify that into your policies, and the auditors should be able to get on board with having a very black and white understanding of how and why and rationalizing your processes. But with that, I see that we're at the top of the hour, so I do want to thank everyone once again for your time. This content information will be provided to you guys to the email address that you registered. But again, feel free to reach out to either Jed or myself. Obviously, you can see I'm very personally passionate about this. I love talking about this. And there's only a handful of us technical folks in the weeds that can have a thorough discussion. So appreciate everyone, and look forward to hearing you guys soon.